Well, you all really excited to see you once again Monday morning, March 24th, 2025, Monday touch point. We're going to update the new listing to pending ratio. Really excited to have you on board. Let's go ahead and get started. Here is the new listing to pending ratio, the single best leading market indicator. I went ahead and updated all of the previous information for the previous week so we can hit it hard. You can see that 2 weeks ago, we ended with a 0.65 ratio. We had 1,440 new listings come on the market, 239 price increases, 1665 price decreases. That's 87%. We did break a trend going back 4 weeks, which is really good. 184 properties back on the market, 13%. 569 active under contract, which is really encouraging. A pretty decent increase from the previous week. 487 pending, also encouraging because the week before 484. But we did end at 0.65 ratio, better than the previous week at a 0.60. But it does put us on that tangible yet substantial, right in between, borderline that tangible and substantial increase in inventory. That is a gain of 568 listings from the previous week. That is the difference between new listings back on the market minus the active under contract and pending at 568 listings. Now, take a look at open house. This is from March 17th all the way through March 24th. 3,048 open houses were held. Amazing. So we're now north of that 3,000. A lot of open house signs out there. I'm seeing a lot of open house signs. We're also seeing an increase in traffic for open houses. So that's a good thing. Not only are we seeing more people doing open houses, but we're seeing an increase in traffic. I'm a big fan of open houses. I personally love open houses, but we are seeing more of those. Tons of activity of open houses for some reason. Absolutely. A lot of people are out there looking around. What's going on? Are there any deals out there? What's happening with the market? So really, really exciting to see an increase in open house activity and also an increase in open house offerings. Let us start updating this past week from the 17th to the 24th. Keep in mind that this information will be updated tomorrow morning. Tomorrow morning, you're going to have access to the latest and greatest. And then the new price increase, price decrease back on the market, active under contract will be locked in forever. And then we will keep on updating the pending information. New listings, 1129, 1,129 new listings, quite a bit lower than the previous week at 1,440. But keep in mind, we're going to see new listings come on the market between now and 11:59 p.m. tonight. Are we going to cross the 1440 mark? I don't think we are. We're going to be shy of that 1440. I would say we're going to be right around the 13 to 1325. So that's going to be lower than the previous week. Let's take a look at price increases. We are looking at price increases at 202, a little bit less than the previous week, 202 price increases. What about price decreases? We are at 1227, 86%. Less than the previous week, currently at 86%. And that is the difference between price increase and price decrease. That does not mean that 86% of the listings had a price decrease. That means that out of everything that could have gone up in price versus down in price, what's the percentage that went down in price? And that's 86%. Back on the market, let's take a look at what's going on with back on the market. We are at 155. 14%. Yet another improvement. So across the board right now, we're looking at improvements. We've got a little bit less listing. We have a little bit less price drop as a percentage, and we've got a little bit more back on the market. The lower the back on the market, the cooler the market. Counterintuitive. The lower the back on the market, the cooler the market. So we actually want to see the back on the market go up. That is a healthy thing. When you have a back on the market increasing, that points to a better market. So I do want to see this number going up from a record low 13%. That is a good thing. Let's take a look at active under contract, and we are at 490. Okay, 490. Not the best number in the world. We still have between now and 11:59 for this number to go up. Is this going to beat the 569? We're going to come darn close to that. But we're at 490 right now. That's fine. It's going to be interesting to see what this number looks like tomorrow morning when we update everything. Now let's take a look at the pending, and you know the drill. I need guesses. I need 5 people to guess the number of pending transactions. 5 people to guess. Okay, we've got Seth starting us off at 222. Melanie following up with 254. Harold coming in at a slightly bullish 270. 3 down, 2 to go. Let's go ahead and get 2 more guesses. We've got Rob coming in at a incredibly bearish, the market is trash, 125. Sonia coming in at 277. Sonia's going to be the bullish one in the crowd. And we've got Farron coming in at 240. Jason coming in at a extremely bullish 378. Let's take a look at it. The number comes in at, starts with a 2, 264. Coming in at 264. A little bit on the bearish side of things. That's going to give us a ratio of 0.59. The good news is that the previous weeks we were like at 0.50. We were even at like 0.4, upper 0.4s, which means at a 0.59, we're going to beat the previous week at a 0.65. As we revisit this number, this time next week, when we are updating the previous week, this 0.59 will be right around that 0.67 mark into the 0.7. That does put us at that tangible increase in inventory. We are seeing way more inventory coming into the market in relation to demand. So inventory is increasing. I've got a few other charts to show you that absolutely puts us in the trajectory of a buyer's market within the area. We are in solid neutral market territory, but we are just going towards a buyer's market. That's going to be a 0.59 ratio. Let's take a look at the year-over-year comparison. Let me make this just a little bit bigger so you can see. We are short 190 listings so far compared to the same exact week 1 year ago, 14.4. We're going to make up about 100 of those listings between now and 11:59 p.m. tonight, which means there's no way we're going to make up 190 listings. Absolutely no way. Now, if you go all the way back to the beginning of the year, we are up right now 835 listings compared year over year. As a percentage, we are up as a percentage. Let's take a look at this. So we're averaging about 8.5% week over week. That's what we're averaging, 8.5% week over week. That's going to be the increase, 8.5%. We are up on price increases. So far, we're down on price drops, but take a look at the previous week. This is from March 10th all the way through March 17th, and we're comparing the exact same week last year, 587 more price drops. Year to date, we are 2,957 more price drops. Back on the market, we are down 51 back on the market. Now, on the pending side of things, active under contract plus pending, I'm going to ignore this week because that's negative 431. We know that that number is going to shrink. But if I go all the way back and I ignore this week, we've got 1,165 less pendings compared to 1,025 more active. So that's a gap of over 2,000. We've got 1,025 more not active but new on the market, and then we've got 1,165 less pending. And you can see that that's why I love this ratio, because that's expressed as a ratio. And when you're at that 0.65, 0.6 to 0.7, you're at that tangible, substantial increase in inventory. Under 0.65, we're in solid, substantial increase in inventory. Under 0.5, I don't want to talk about that. I don't want to be negative, but under a 0.5 ratio, there is no market. That's basically a crash market. And the data proves that. Now, let's take a look at some comparisons. Because this past week, we're at a 0.59 ratio. We're going to settle closer to that 0.7 ratio. The same week last year, we settled at a 0.78. The previous week, 0.63 versus 0.93, 0.60 versus 0.8, 0.75, 0.77. So we have been, except for this week, February 10th, 2025 to February 17th, we had exactly the same ratio. But apart from that, we are definitely lagging last year when it comes to the supply of homes entering the market in relation to the demand for homes currently in the market. We are trailing last year. I hope this market picks up some. I do agree with you, Melanie. I do have some things that I want to share with you. I don't want to overwhelm you all with new information or with data, but you know what? We crossed that line many years ago, but I've got some really cool resources to share with you. And these are like resources for me. I don't want you using what I'm about to share with you in a listing presentation or a buyer presentation. This is like my stuff that I rely on. I want to share it with you so that you can see where I'm coming from, but don't go using this it's kind of not because it's complicated. Everyone here is super smart. You're able to get it in 2 seconds. It's just going to be overwhelming and complicated for the client. This is like that family business type stuff, but I do want to share some information here with you. Let's go ahead and take a look at the monthly. I went ahead and updated all of the previous months, so we're all set. February, we're at a 0.75 ratio. Nothing really changed there. Let us start updating the entire month of March and see what's going on. New listings so far, 6-county area. Keep that in mind. That's Travis, Williamson, Bastrop, Hayes, Caldwell, along with Burnett counties. And so far, from March 31st all the way to right now, we are at, 3,902 new listings. We're almost beating last month, which is normal. This is to be expected. March will have more new listings compared to February. Let's take a look at price increases. We are at 580. Let's take a look at price decreases so far this month. We're at 4,272, 88%. A little bit better than February. That's a good thing. Let's take a look at back on the market. We are at currently 520 back on the market, 13%, very much on the bearish side of things at 13%. That is going to be a record low. Actually, I think we need to go all the way back to 2004, 2003 to get a 13% mark. Let's keep on going. Okay, yes, we have to go all the way back to 2004. February of 2004, we had a 11% back on the market. So we have to go back, 21 years to get a back on the market percentage that's going to be south of that 13% that we currently have right now. Let's take a look at active under contract. We are currently at 1,514. It is the 24th, and there are 31 days in March. We're going to beat February, which is a good thing. We're going to beat February. February, we had 1,751. Now, the challenge is that March 2024, we had 2,194. let me do this. Let's run some really quick little calculations here. Let's go 1,514. And let me do this. We're going to go equals 1514 divided by, I'm going to do 23. I'm not going to count today. So we're at 66 per day. And how many days do we have left counting today? We've got what, 26 or 24, 25, 26. How many days do we have between now and the end of the month? What is it? I need to get like my calendar. Let me get my calendar right here. I've got a calendar right here in front of me. So we've got exactly 7 days, 8 days. Let's go ahead and do 8 days. Okay, perfect. So we've got, let me just keep on using this one. Yeah, let's just say this, 66 times 8. And we're going to go this plus 527, 2041. So the expectation is that we're going to have close to 2,041 active under contracts. That is going to be south of the 2194. So unless something borderline miraculous happens between now and March 31st, we're going to be lagging last year, March of last year, when you look at active under contract. Now let's take a look at pending. We are at 1143. Wow, 1143 pending. That's going to put us at that 0.60, exactly 0.60 so far this month. That number's not going to move up dramatically. We are already 24 days into the month. It's going to settle somewhere around the 0.65 to 0.67 as we revisit this number over the next few weeks. But we are really deep into March at a 0.60. And keep in mind, this is supposed to be the highest demand, March and April. I'm really hoping that something turns around between now and mid-April, because if we don't see an increase in demand between now and mid-April, that's when we start getting all the price decreases. That's when we start getting all the stagnant listings on the market. And that's where prices start going south. That's a 0.60. We'll take a look at some charts, but let's go ahead and update the sold so far. We are at 1,768 sold. And withdrawn, we're at 377 withdrawn. And what about expired? So far, we're at 211 expired. Let me go ahead and just move this out of the way so that I can print this out as a PDF. And we can take a look at absolutely everything. Take a look at some charts and see what is going on with the ratio in relation to other months. Let's go ahead and just give me 1 second so I can get this going as a PDF, and then we can update everything here for you. This is printing out as a PDF. It's just going to take me another few seconds. And let's see here, we're going to go all the way back, and let me open this up as a PDF for you so we can start looking at some really cool charts, and we can go from there. I need to save it, and let me get this going. Okay, perfect. Here we go. Here's the new listing to pending ratio. Let's take a look at some of the monthly data, but let's start with open house. Take a look at open house. So we are at 3,048 open house this past week. That number's going up. But let's look at the monthly new listing to pending ratio. Well, first, I want to show you the difference between new and pending. We are at 1,765. That's going to be the difference between everything new on the market and everything that is pending. New meaning new listings plus back on the market, minus properties that are active under contract and pending, 1,765. Where does that put us? That puts us, we have to go all the way back to 2003 to get a number that's going to be higher than that 1,765. And we can see that last year we had 1,344. This year, 1,765. That's going to be the difference. When you look at the ratio, There's that 0.60. Now, last year for March of 2024, the ratio was 0.76. We can see a little bit of a bump right there from January to February from 0.69 to 0.75. And then here we have 0.60 right now. April of 2024, we were at a 0.72 ratio. It's going to be really interesting just to continue updating this information to see how April plays out, especially with all the additional new inventory currently in the market that will absolutely provide pressure when it comes to pricing. Will that cause buyers to come out because they will see better priced properties out there? That is a guarantee simply based on the amount of supply in relation to demand right now being expressed by this ratio. This goes all the way back to the year 2000, and you can see where we are right now at a 0.60 ratio. 2022, that was not the month of March. That was, I believe, June or so. Let me take a look at this. We had a 0.58 ratio in June of 2022. That's going to be the lowest one, June 2022, 0.58. We're at a 0.60 right now. But when you compare the actual month of March, we have to go all the way back. Okay, this ties 2004 at a 0.60. And you can see this is for every March going all the way back to the year 2000. Active listings for the 6-county area, 11,928. And I am happy to report to you that that is the highest active inventory for the 6-county area on record for the month of March. We're up 11.1% year over year on the number of active listings currently on the market. We're 35.7% above average on the number of active listings. Now, once we adjust this for population, we're nowhere close, and that's a good thing. That's why I like to adjust it for population. It creates an index. It creates a apples to apples comparison. We are up 11.1% compared to last year when we adjust it for population, but we're only 2.4% above average. You can see that 2008, we had 699 active listings per 100,000 people. We're at 469. We've got a ways to go. I'm not concerned about that when we adjust it for population. Now, on the demand side of things, we are noticing a lagging demand even when we adjust it for population. Let me go take a look at the pending, back on the market. Let's find pending. Okay, perfect. Here's the pending. Pending properties for the month of March, but what I want to do is I want to take a look at everything, the cumulative, January, February, and March, and you can see that we are 21% year over year lower this year compared to last year. So we're 11.1% higher on the number of active listings, but we're 21% lower on the demand side of things. This is going to be pending, everything active under contract plus pending, 21% lower year over year, cumulative. Now, one thing to keep in mind on cumulative, last year's figure includes all of March, but we're March 24th. So this number is going to go up, but it's not going to go up by an astronomical amount. We're already March 24th right now. When you look at okay, this is cumulative. Let's take a look at adjusting for population. This is where it gets a little bit challenging, is that when you adjust the active per population, we're not reaching record highs, and that's a good thing. But when you adjust the cumulative pending, everything that's gone pending from January all the way to now, we are down 22.9% adjusted for population, and we're at 364. We have to beat 2009 at 386. We're either going to come very close or we're just going to beat it by a little bit. But we're going to come in second, meaning second lowest cumulative pending adjusted for population, going all the way back to the year 2000, 25 years worth of data that we've been tracking. We're not going to come in higher than 411. That was 2011. I would say we will absolutely come in higher than 2009. We're going to be in between 386 and 400. That's where we're going to land. That is amazing. That just goes to show just how much, just a lack of demand that we're experiencing this year. Really incredible to look at it this way. And it's not rates. I mean, rates are pretty much steady compared to this time last year, but we are experiencing a slowdown in demand. It is encouraging to see an increased walkthrough in open house. That is encouraging. Could things change in April going into May? Could the sales cycle have expanded a little bit? No doubt it could very well have happened, but there are other indicators that are showing pretty much across the board pullback in buyer demand. Now, it's important for us to know this, especially on the listing side of things, but also on the buying side of things. The buyers have choices right now. The buyers, they're taking a little bit longer to make a decision. They're looking at way more homes. Sonia said buyers are very cautious and are taking their time. They take one step forward, two step back. Very well said, Sonia. You're absolutely right. Let's go take a look at that house one more time. Oh, wow, another listing came on the market. Let's go take a look at that one. Oh, wow, another listing came on the market. Let's go see that one now. That is exactly what is happening. And it's normal. It's a normal thing. The sales cycle is increasing just a little bit. Buyers are indecisive right now. I had an agent saying that she was writing up an offer for my listing on Friday. Still nothing. Well, Seth, you're absolutely right. As a matter of fact, I'm still waiting on offers from 2005. It took one of my buyers 5 days to sign on a new construction home that they wanted. There you have it. The sales cycle is increasing. And we have to be aware of that. We have to be patient with that. We are a fiduciary to our client. Obedience, loyalty, disclosure, confidentiality, accounting, reasonable care. So don't rush the process. The buyers have a lot of choices. It's a beautiful thing. I'm glad the buyers have choices. I'm glad that they can sleep on it. And as a fiduciary for our clients, we just have to be there for them every step of the way, understanding that they have options, acknowledging that they have options, supporting their options. And I'm really glad that we do that. Let's take a look at a few more things. I'm going to look at the overall ratio for the entire year. So far, for the entire year, from January 1st until March 24th, we've got a ratio of a 0.68. 0.68 ratio. We've got another comment, and the agents don't respond. I feel it is because they don't know what to say because their buyers don't get back to them. It's a very good point. They look at the overall mortgage payment, and it's a serious problem, and that is a part of it. Very well said. That is exactly it. So you look at a house, you like it, you run the numbers with the taxes, with the insurance, and it's a little bit of a shocker. It's like, whoa, wait a second here. Let me really think about this. Do I really want to move forward with this? That's very, very well said. So we're at a 0.68 ratio right now. And wow, my insurance went from $2,400 to $5,300. That is amazing. Absolute shocker. As a matter of fact, I just got a email from my mortgage company saying, hey, your insurance went up, which I knew it went up. I knew about it before they knew about it. And of course, they had to adjust my escrow. And they're like, hey, here's a few other companies that you want to shop. I'm not even going to shop around for it. It doesn't matter. It is what it is. So we're at a 0.68 ratio. And I want to tell you right now, you all, the ratio doesn't lie. The ratio never, ever, ever lies. If there are two things that I trust in life, number one, it's the good Lord. Number two, it's this ratio. It does not lie. So we have to be aware of it, and we have to understand that a 0.68 ratio is absolutely going to put us in the trajectory of increased inventory, therefore higher months on the market. That's what's going to happen. So let's take a look at inventory right now for the entire MLS. We crossed the 5. We went from 4.8 January to 5 February to now 5.4. Now, to put that in perspective, March of last year, we were at a 4.2, and now we're at a 5.4. When you look at the number of active listings across the entire MLS. Now, let's focus within our 6-county area. We are currently at, as of this morning, 13,697 active listings. That is a 144 increase from Friday, 333 week over week, 1,596 month over month, 13.19% month over month, 20.4% year over year. Good news on pending. We're at 4,379 pending. We are down 9.9% year over year, but I'm glad that that's not a 10. We got up to 11.2%. As a matter of fact, we were up to 12.6% decrease in pendings February 18th, March 24th at a 9.9. So I am glad that this number is shrinking, but we are down 9.9% year over year on the number of pending. And therefore, the activity index increased just a little bit to 24.2% from 24.1, just a tiny little slight increase. When you look at the 6-county area, we're at 4.84 months of inventory as opposed to the entire MLS. So we are outperforming the entire MLS. I like to focus within the 6-county area. It is our primary market. 95% of our deals are within the 6-county area. So I do like to focus here. When you look at the breakdown of property condition and special listing condition, but more so the new construction, 27.3% of all of the available inventory is new construction, yet it accounts for a staggering 41.7% of all pending. That's going to give us a very healthy activity index of 32.87%. On the resale side of things, we've got an activity index of 20.43%. 20.43% activity index on the resale side of things. Let me just adjust this really quick. My little headphone came off, so I need to plug it back in. Okay, there we have it. 20.43% activity index on resale. Resale accounts for 72.7% of all the active listings, and it accounts for 58.3% of all of the pending listings. You can see active listings up 20.4%, pending down 9.9%, activity index down 19.1%, and therefore months of inventory is going to be up 22.1% year over year. That's going to be months of inventory. This time last year, we were at 3.97 months of inventory. We are currently at 4.84 months of inventory. One of my absolute favorite resources that we publish on a daily basis is going to be the percentile analysis. This is what this percentile analysis means. In the city of Austin, there are 4,022 active listings on the market. 10% of those, meaning 402, are priced at $315,000 or less, at $227 a foot or less. 102 are priced both $227 a foot and less and $315 a foot or less. And then you've got the 25th percentile, meaning a quarter of the properties out of the 4,022, so 804, are priced under $429, under $273. And then, of course, you've got the median 50 percentile, then 75th, and then 90th percentile. The reason I like this field right here, that's your value column. Those are the prices that are under the 10th percentile on the price and also the price per foot. So they're decent sized properties in relation to the available inventory. And that 102, that's going to be a record high. And this proves what we've been saying about the bifurcated nature of the market. When you look at this percentile analysis and the year-over-year change in price, you can see that the 10th percentile in the city of Austin is down 5.2%. Meaning if I take a look at everything that sold last year, a 30-day snapshot last year, and then a 30-day snapshot from today going back 30 days, the 10th percentile is down 5.2%. The 25th percentile is down 4.7%. The 50th percentile, 75th percentile, 90th percentile, up. 50th percentile, up 6%. 75th percentile, up 6.2%. A staggering increase in price. 90th percentile, up 5.6%. That right there proves that theory that we are experiencing a bifurcated market, is that the higher percentile continues to experience demand and those prices are going up, whereas the bottom percentile, the bottom 35th percentile, is experiencing a lot of headwind. Now, this is for the city of Austin, of course. Different cities are experiencing different things. But when you look at the Marble Falls, 45%, Lago Vista, 25%, Lakeway, 7.8%, Leander, 1%. You've got Round Rock. Look at the 90th percentile in Round Rock, up 16.1%. San Marcos, that's up across the board. Everything is up across the board in San Marcos. Every percentile is up across the board. So really, really interesting to see what is happening with the market right now, because it doesn't make any sense unless you break it down with the percentile analysis. How can we have a 20% drop in pending? How can we have more price drops? How can we see a new listing to pending ratio going down? All of the indicators are pointing south, and yet prices are going up. It's because of what is selling. In the price point that is experiencing the single biggest headwind is going to be the bottom 35th percentile. It's all about affordability. Homeowners insurance going up from $2,000 to $4,000. Do you think that affects, as a percentage increase, do you think that affects the person that lives in a $400,000 house more than a $4 million house? Absolutely. You better believe it does. And that's what's happening right now, is that the upper 75th percentile is actually doing quite well. Those properties are doing quite well. Now, the number of homes is going down, the number of homes selling, everything is going down on the number of sold, but the price of the upper 75th percentile is actually going up. So really interesting. The data proves that, and it's good for us to have access to this data. Can you show this for the 78747 zip code? Absolutely. Let's take a look at the 78747. There we have it. Oh, that is such a good example right there. So here you've got the 10th percentile down 11.5%. The 25th percentile down 8.7%. 50th down 8.1%. 75th down 10.9%. But look at that 90th percentile, up 7.8%. Really, really amazing. So what is the price point for the 90th percentile? The price point for the 90th percentile in the 78747 on the sold side is $607,000. On the active side, it is $694,498. Really amazing. Which means out of 116 properties on the market, 11 are priced higher than $694. That's what that means. That's the 90th percentile. So 11 out of the 116 are priced at $694,498 and up. I love this percentile analysis. Absolutely love this resource. Yet another tool in your tool belt, right? So use it as you feel is appropriate. Let's take a look at the activity index really quick, and you can see pullback within the activity index in certain zip codes and certain cities. We've got Austin pulling back a little bit from 24.5 to 22. Bastrop pulling back. Buda pulling back. We've got Burnett County. That's gone up. That's encouraging. We've got a really big pullback within Cedar Creek. Cedar Park is going up. Dale is going up. Dale Valley just about collapsing. I mean, it's still a healthy 34.2% activity index, which is the pending divided by active plus pending. Very healthy 34.2. But look at February, 41.2% activity index. Elgin, record high. We've got a 12-month record high on Elgin. Let's take a look at a few here. We've got a really nice increase on the activity index for Lago Vista. We bottomed out at 9.5% in January, and we've gone up to 16.1%, which is really encouraging for Lago Vista. That's been a very tough market here over the past 18 months. Leander, though, record low activity index, plummeted. Year over year, we went from a record high to a record low in Leander year over year. What a difference 1 year makes. From a very healthy 37.5% down to bearish territory of 22.7%. Once we go below 20%, that points towards a buyer's market. At a 22.7%, that is on a neutral to bearish market. Neutral to cooler market. We've got Marble Falls, record low at 10%. We've got Smithville, Wimberley doing very well. Kyle, let's take a look at Kyle. Kyle, we're at 29.1%. We hit a low at 26.1% July of last year. Little bit of improvement in Kyle. Although we are down from December, we are at a 29.1%. So that did go up a little bit on Kyle, so that is encouraging. Let's take a look at some zip codes and see what's going on with the activity index in certain zip codes. I'm just looking for record highs and record lows. 03, 12-month high. 05, 12-month low. What else? What other highs and lows? We've got Leander. There's right there, 78641, which is basically all of Leander. That's a record low, 23%. We've got Dripping Springs reaching a record high at 26.3. San Marcos, record high. Way to go, San Marcos. Wimberley, record high. Elgin, record high. Smithville, record low. Real estate is hyper local. You've got to rely on that specific zip code, that specific area. What about Georgetown? Let's take a look at Georgetown really quick. The entire city of Georgetown. Yeah, Georgetown is pretty flat. We're at 26.6, a little bit of an increase from 25.8, which is a little bit of an increase from 24.6. It's pretty flat. We bottomed out at 23.2 back in June of 2024, and then we had a high March 2024 of 29.8. We're at 26.6 right now. Not the biggest difference from a year ago at 29.8. Not that big of a difference. So holding steady, very just nice and steady, Georgetown. Let's take a look at the price per foot. You're going to notice a slight little tweak to this resource. I'm really excited about this new column that I added. Pending versus sold on the median price per foot. What this means is that if you see a red dot there, it means that the pending median price per foot is lower than the sold median price per foot going back 90 days. And what does that tell you? A decelerating market. That's what that tells you. that guarantees, and I've pulled this data going back years, it guarantees that prices are going down within these cities. Because if it's pending at a lower median price per foot, guess what? It's going to sell for a lower price per foot. That's what that means. So these 7 dots, Burnett, Cedar Creek, Del Valley, Hutto, Lakeway, Manchac, Smithville, Spicewood, 7 out of the top 30 cities that we track. Now, that does not mean that the other ones are going to go up, because some of them, it's only off by 1.7%. And guess what we have to take into account? The sold to list price ratio. And if we've got an area that's a 97% sold to list price ratio, then that still means that the sold is going to sell for less than what sold over the past 90 days. But I'm not going to go through that math. I could, but I'm not. Now, on the zip code side of things, out of the 75 zip codes that we track, 20 of those zip codes, we have a pending price per foot. The median, the pending median price per foot is lower than the sold. Some of them are substantial, specifically 78701. A lot of pressure on that 78701 zip code. Really low activity index, really high inventory, especially for certain price points. When you look at the activity index, as a matter of fact, let me go ahead and do that for you, because this is shocking. Let's take a look at the activity index for the 78701 zip code. Here's the activity index. Let me open this up. Let me make this a little bit bigger for you. Take a look at this. All of these marks where you have red and 0, that means there is no activity. There's no activity. Then nothing is pending. You've got inventory there's absolutely nothing pending. Just incredible just to take a look at this. Only a 7.1% activity index in the 78701 zip code. And then on top of that, when you look at the price per foot, we're down 23.8% on the median price per foot on pending in relation to the median price per foot on what's sold over the past 90 days. What does that mean? Prices are going to go down in the 78701 by double digits over the next 30, 60, 90 days. That's a guaranteed, that's what that means. 23.8, is that going to be the highest number? Yes, that's going to be the highest number. But use this as a resource for your listing presentations, working with your clients. And then you've got zip codes that just way, way higher. Way higher. I mean, use this as a resource. Now, let's take a look at a few more things right here. We already went over the new listing to pending ratio. We went over the price per foot. This I'm going to cover later on. We went over the activity index city, activity index zip code, went over market update, went over percentile analysis, went over this one. Okay, let's stick with this one. This is going to be the residential inventory. I created this cover sheet right before you get into the residential inventory, so you can just get a really good snapshot, and it breaks down the data so you can just see exactly what's going on, number of active listings, new listings pending, and also the year over year. This will be updated daily. And then all of the rest of the data is exactly the same. I just organized it a little bit better for you. Wanted you to know that this is now just a little bit better organized. We've got all of the Austin area MLS first, and then we go to the city of Austin, but we broke all that down here. So this is really, really good for you to see. So let me go ahead and close this one. Let's talk about market cycle. And then I'm going to show you a market performance resource for me. You are welcome to use it, but this is for me. And it'll point out to what the direction of the market looks like. And it's a super powerful leading market indicator. I'll go over some of this. But so far, the projection is that we are going to sell within our 6-county area 2,325 properties. that is going to be, looks like we're going to have another double percentage dip compared to last year, March of last year. Pricing, this is that bifurcated market showing itself on pricing. That even though sales are down approximately 16.9%, prices are up 5.4% month over month on the average sold price, and it's up 5.8% month over month on the median sold price. That is driven by the bifurcated nature of the market, upper 75th percentile doing very well, as opposed to the bottom 35th percentile experiencing a lot of price pressure, a lot of pressure within affordability. Now, on the average sold price, we are still down, of course, 13.38%. On the median sold price, we are down 18.26%. But, going all the way back to November of 2022, we've had 4 months worth of year-over-year gain in pricing. It's going to be interesting to see what happens in April and May. Those are going to be the critical months to see how long of this selling season are we going to stretch into the second quarter, and how many price drops are we going to experience over the next 60 days with the added inventory that we're experiencing. And the new listing to pending ratio points to that we are going to experience a tangible plus increase in available inventory simply because of the drop in demand, the 20% drop in demand cumulative from January all the way to March. And we're already at a 11+% increase in inventory. Let's look at a few more things. When you look at the entire year, every single thing from the start of the year until now, the average sold price for all of 2025 is $561,844. That is a drop of 1% year over year. On the median sold price, all of the properties that sold, we're looking at $428,196 median sold price. That's a 2.9% drop year over year. This is going to be a projection, a 27,770. That right there, 2025 total sold, is a projected figure. That's simply based on what has sold. So we are going to be negative. Last year, we were positive year over year, 301 properties. We sold more properties in 2024 compared to 2023. Looks like we're going to retreat. Looks like we're going to be closer to that 28,000 mark. It's really early. It is March 24th. Could the market improve dramatically? It could. I'm very hopeful. I have lots of hope. Statistically, March, April is the peak of the market. When you look at pricing, it tends to go down after March and April. The sold to list is matching 03 and 04. Absolutely. There's that 97.2. You've got 2023, 97.02. You've got 2012, 97.3. And look at that 03, 04, 97.2, 97.3. You're absolutely right. We're right within that sold to list price ratio. You're absolutely right. Now, you ready for some information that I personally rely on? So there are a few reports that I put together for my own use. I love ratios, and this is the active to pending ratio. A ratio over 2 signals a seller's market with high demand. A ratio under 3 indicates or greater than 3. A ratio less than 2, seller's market. A ratio over 3, buyer's market. And we're at 4.58. ratio right now. Active to pending ratio, 4.58. And these numbers simply don't lie. Here's the active to sold ratio. And we're at 6.85. Everything that's active in relation to what has sold, 6.85. And we have to go all the way back to 2009 at 7.74. Pending to sold ratio. Here's another one. A declining ratio signals issues like financing problems or buyer hesitancy, while a stable or increasing ratio suggests a healthy closing rate. This is the rate of properties that go pending that actually close. We're at 1.49 right now. And we're backtracking a little bit from 1.57. This points to that buyer hesitancy. This is where the numbers prove what we are noticing out there in the field. It's like, let me just wait. The number proves it. We've got new to active ratio. Compares the number of new listings to active listings. A high ratio, over 30%, points to a rapid influx in new inventory. Look at 2021, got up to 198%. What happened in 2022? We hit a record high, but that's where a rapid influx of new listings. Sold to active ratio. A high ratio over 20% indicates a strong seller's market with demand. A low ratio under 10%, a sluggish. So we're at 15% right now, 15%. So we're right in between, that's that neutral market, right in between that. Sold to active ratio. Now we get into, we got activity index. You know what that is. This is an interesting one. Pending to supply index. And what I do is I calculate this by dividing the number of pending by the number of active. And simply the pending to active ratio. And then I multiply that by the number of sold properties. And what it does is it creates a weighted ratio. And the higher the index, the greater pressure on supply to pending. And it reduces the available inventory. So when you've got a really high number, that's going to provide pressure on supply, and it points to a higher demand, lack of inventory, which means prices are going to keep on going up. We're at 380 right now, and that's almost half than February. What does that mean? That means added pressure on pricing. That's a guarantee. That's what it means. The numbers never, ever lie. This is the speed at which demand, meaning pending sales, in sold homes are moving relative to the active homes. You know me, I am a contrarian. If the market is going in one direction, I want to pull as much data as I can to all right, is this real? I don't want to just rely on the new listing to pending ratio. What's the entire picture of the market? Is there an outliner that is pointing to a completely different set of circumstances that one individual ratio isn't showing me? That's why I put all of this together, just so that I can fully understand the market. And you can see that this one, as a percentage, the higher value indicates a faster market velocity, meaning a larger portion of active homes are either pending or sold. It's an active market. And we can see that the single most active market going back 20 years was March of 2021. Prices peaked May of 2022, but things started slowing down. And this is why we could see that the market had peaked, because this got down to the 48%. And we're like, all right, things are not moving as fast as they would. Okay, the market absolutely peaked. We're now going to experience pressure within pricing. So I've got a lot of these charts. I'm not going to go over everything. This is a good one, Market Health Index. What I do is I combine multiple different indexes from velocity to absorption to inventory, and it simply gives us a market health score. And it points to and when you see healthy for one is not healthy for the other. A healthy market for sellers is what? A brutal market for buyers. But that was 2021, March at 129%. A higher market health index indicates a strong seller's market. 30 to 70% a balanced market. Under 30% a buyer's market. this is a leading indicator. And we're at 16% right now, down from 21%. This is when you take everything together, what is the health of the market when you apply all of these different metrics together? I'm just going to show you a few. This is probably, I would say, my favorite one. Demand momentum measures the relative growth rate of demand pending in supply. A positive value indicates demand is growing faster than supply. A negative value indicates that demand is decreasing in relation to the available supply. And we can see that when the market peaked May of 2022, which, by the way, go back and listen to my previous recordings. When did I start saying, hey, you've got to stack your pipeline and you've got to market like you're in a recession? When did I start saying that? Do y'all remember? It's on the recordings. It was a while ago. It was actually a few years ago. When did I start saying that? It was 2 years ago. Well, why is that? Because the ratio went, I believe it was actually January of 2022 is when I started saying that. It's because the ratio went negative. It's the demand for real estate in relation to the availability of supply started backtracking. And at that point, it was like, all right, things are slowing down. The lagging indicator is going to be pricing. The lagging indicator is going to be months of inventory. That takes years to manifest itself. And let's just take a look at a few more things. This is a market health score, a weighted market health score. And you can see that a seller's market is over 70%. A balanced market is 30% to 70%, and a buyer's market is under 30%. And where are we now? We're at 29%. So the good news is that we are absolutely beating 2023. 2023 was just absolutely brutal. First quarter of 2023 was brutal. First quarter 2024 was encouraging. We are in between 2023 and 2024 when you look at the overall health of the market. When you combine everything together, what is going on? All of the data, all of the indicators. Now, you can just have an absolute blast with all this information. You can get all of this on Insight and Statistics, scroll down, go to Market Performance. We've got individual pages for all this. You can click on any one individual page. It gives you the context. It explains exactly what this is. But I put this under like the family business category. If you really like to dig deep into the data and understand the market broadly, what is one number that points to the overall health of the market? These numbers never lie. You can go back and you can say, wow, what happened back in 2020? Oh, wow, this happened 2020 and then 2022 prices peaked. These numbers never, ever, ever lie. So take a look at that. Data that I've been tracking, I went ahead and published that so that you can have access to it, but you can go at it. It's totally up to you. We're not going to spend, it's probably the last time I spend on this unless you want to have a personal conversation with me. I'm not going to include this on any of my updates. This is just my stuff that I love to look at. But if you ever want to take a look at some of these really future leading indicators, what I like about some of this data, especially the demand momentum, the weighted market health score, is that these are 18-month leading indicators. Whereas the activity index is a 2 to 3 week leading indicator. The new listing to pending ratio is a 2 to 3 week leading indicator, or at max a 2-month leading indicator. Some of these are 2-year leading indicators. And as soon as these percentages start going up, I'll tell you with a high degree of confidence, hey, the market's back. So that's why I rely on this information. Let's take a look at the economic calendar really quick. And we have a very important week this week. We've got building permits out on Tuesday. We've got the home price index also out on Tuesday. We're going to update the our internal home price index, the national market index, tomorrow as soon as the data is out at 8 a.m. We've got consumer confidence. The big one, though, is going to be GDP on Thursday. Those are not going to be preliminary figures. Those are going to be final figures. That's going to be a very important day. And then we've got inflation data out on Friday. We've got PCE. Now, the bond market has taken a little bit of a beating today, especially because of all the tariff news that is coming out, that it's going to be more targeted and narrow. Over 100 countries are not going to be a part of the tariff. So there's a lot news dump that happened over the weekend. The market is reacting in a very positive way. The equity market is reacting in a very positive way. And when you can see that the equity market is reacting in a positive way, that means that the bond market is going to experience a little bit of a sell-off. If there's a sell-off within the bond market, that means that what? Prices go down. And if prices go down, then the yield goes up. So when you take a look at rates today, we are currently at 6.625 for the conventional 30-year. FHA at 6 1/8. Same thing with VA and USDA, but that's going to be your weekly rate update.